Hi, I'm Anthony Manley from Global Trading Edge, and this is Level 1 Technical Analysis. First of all, Topic 1. We need to understand price analysis. That's bar charts, or what is commonly called the OHLC bar, or Open, High, Low, Close. Let's have a look. There are three types of charts. We've got line charts, candlestick charts, and bar charts. You will use all three of these in the Financial Freedom course. They all have their own relevant areas of expertise. Line charts are used, candlestick charts are used, and bar charts are used. The OHLC, or the Open, High, Low, Close bar chart, is made up of open price, high price, low price, and close price for any particular trading period. So let's have a look at the actual open, high, low, close bar. The high price is the highest price that buyers are willing to pay. The low price is obviously the lowest price sellers were willing to sell at. The close price tells us if buyers or sellers are in control. Professionals close the market. The open price is definitely the first transaction of the day. That's the motion charts, and what we mean by that is that it all depends what's happened overnight. For example, overseas, if we're talking about the Australian market. In the US, believe it or not, the Australian market does have an impact on the US market at the moment. Let's understand the bars themselves. If you look at the one on the left, we've got what we call the perfect bullish up day. Now what we mean by that is you can see that it's opened near its low for the day and it's closed near its high for the day. That's classed as the perfect bullish up day. If we look at the one on the right, we have what's called a typical bullish up day. And what we mean by that is if you were to break the high and the low, that's the longer line up and down, the vertical bar, into thirds, then you would see that in the top third, that's where the share closed. In the bottom third, that's where it's opened. If, for example, they opened and closed in the middle third, then it wouldn't be classed as a bullish day or a bearish day for that matter. We're about to get on to bearish days. The perfect bearish down day. You can see there it opened near its high and it's closed near its low. That's what we call the perfect bearish down day. On the right hand side, you can see we've got a typical bearish down day. Again, break this into thirds. You can see that we've got the high, the low, the open, and the close. And you can see it opened in the top third and it closed in the bottom third. That is what we call a typical bearish down day. If we had it open and closed it in the middle third section, that's what we call indecision. If it opened in the middle third and closed in the bottom third, again, that is not classed as a bearish down day. Let's understand consolidation. Consolidation signifies indecision in a share. Price movements stagnate or trade sideways. The bulls and the bears are in a battle. Who's going to win? When a winner emerges, we see a price breakout. Let's have a look at that. Look at this chart here. You can see that either side of this particular breakout, we're talking 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. That's a 20-day period where the stock actually trended sideways before we saw this perfect bullish up day, or what's commonly called a breakout. So it consolidated for 20 days and then we saw this breakout. These breakouts, I cannot emphasize enough how important they actually are when trading. The longer the trading range, the more explosive the breakout. You saw on the previous page, if I go back to that, how it broke out of that particular trading range there. Consolidation areas tend to form at round numbers. So it consolidates normally at a round number. So $10, $11, $15 is classed as round numbers. $11.50, that's a round number. Consolidation patterns are formed after 3 days of conflicting signals. So let's have a look here. As you can see, starting from where the actual to the left of where the breakout actually was, the first day, You can see there it's not really a bearish or a bullish day. The very next day it looks bearish, it goes down. The third day in, there's still no full direction as to what's actually happening. You can see there it opened in the top third and it's closed almost in the top third of that particular bar. So as you can see, we've got a bit of indecision going on, and that's what we mean by consolidation patterns are formed after 3 days of conflicting signals. We've had an up, a down, an up and down. No one knows really what's going on. Remembering that time works against us when buying options, we exit on the third day of consolidation. So if the stock consolidates, exit if you're in a position. There's no need to write down these rules, as you will get the list of the rules at the end of each of these sections. So, consolidation rules, here we go. We sell out of any bought position after 3 days of sideways movement. If the stock trends sideways, get out. If you're not in a position, simply stay out. Do not trade until there is a clear breakout above or below the trading range, support or resistance. You are going to learn more about support and resistance as we move along.